Hello, I'm Nathan Kubik, and thank you for joining us for the 2022 end of the third quarter Transform Wealth Capital Markets Review. I hope you are all doing well. Thus far, it has been a challenging year, and we have a lot to discuss about this quarter and going forward. Today, we will be discussing the continued volatility, what's driving that volatility, as well as the key influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. The most critical factor in the markets is that of inflation, which has stubbornly remained at historically high levels. The Fed has hiked rates 5 times in 2022 and has indicated an additional hike to come. While it does appear that core inflation growth may have peaked, the timing of getting inflation under control remains an unknown. Corporate earnings have remained resilient, and this will be a key quarter to watch those earnings releases, as we should see some indications on the impacts of higher interest rates and inflationary pressures. Market valuation metrics have moved further below their 25-year average, which also has some implications that we will be discussing. Ultimately, there are meaningful headwinds facing the markets right now, and how the Fed, consumers, and companies navigate those headwinds will determine what happens next. The big question is whether or not we can bring down inflation without having a hard landing. As you will see, in each of our strategies, we are positioned with this in mind. Before jumping into economic and portfolio positioning discussions, we wanted to explain that this is not a typical market downturn. Generally, when there are fears of a recession, there is a flight to safety. The stock market suffers, and there is an increased demand for bonds. This demand for bonds then leads to higher bond prices and lower interest rates. This inverse relationship between stock and bond performance usually results in a balanced portfolio benefiting in overall performance as a result of that diversification. However, this particular period is different. Now, this is not the performance of our investment models, but rather they are the broad market indexes. But as you can see, both stocks and bonds are down in this window. This is because the current market downturn comes as a result of the Fed's actions and their manipulation of interest rates to combat inflation. It is important to understand that this inflation has come as a result of the stimulus packages put in place during COVID, and has been compounded by many other implications related to COVID. Supply chain issues and pent-up demand situations are abating, but the estimated 5 million baby boomers who retired is continuing to have an impact on the labor force. Additionally, the war in Ukraine is continuing to have worldwide implications, including those of inflation. Looking at this chart, we can see that inflation growth is at problematic levels. It does appear that the growth rate may have peaked in July, but bringing this rate down will take some time. And if it has peaked, this is important. Historically, stocks perform poorly as inflation rises. However, once that inflation rate peaks, stocks tend to perform well. Remember that we don't need prices to return to their previous levels, but we do need the continual growth rate of those prices to move back towards normative levels. Looking more granularly at the contributing factors to inflation, we see that some of the factors are indeed lessening. Additionally, looking at the chart on the right, we do see consensus estimates forecasting it to continue downward. There are some headwinds, and will likely be some continued economic pain ahead. However, it is our hope that we can navigate these without needing a hard landing. And while that is our hope, we do recognize that we are still operating with an unknown timeline and no certainty that the worst of inflation is behind us. To that end, each of our investment models is positioned with this in mind. On the transitory side of inflation, we are seeing supply chains having less of an impact on pricing. Here we consider the Purchasing Managers Index, or PMI. This is a monthly survey of supply chain managers across a number of industries. As you can see, delivery times are falling, and prices of inputs and outputs are as well. This, combined with what we are hearing from corporate executives and through company filings across the country, it tells us that supply chains have and do continue to improve. The labor market is not quite so far along. However, there are signs that it is changing. Unemployment levels are at record lows, and wage growth has become a concerning factor. This is a key factor that the Federal Reserve is watching. Wage growth is a meaningful factor when considering inflation, and here we see that it may have peaked. When it comes to employment, we are in a strange time period, a time where the equity markets are wanting to see higher levels of unemployment, or at least that wage growth has moved back down. The reason for this can be seen in the chart on the left. Consider the relationship between job openings and job seekers. There are nearly twice as many jobs available as there are people looking for a job. This comes in part as a result of the 5 million retirees over the last couple of years, which has left a vacuum for many roles. This has resulted in companies paying more to hire and maintain employees, which has impacted spending power for those employees, which has encouraged increased demand and is a partial reason for some of the higher prices we are seeing. This is one of the reasons that the Fed is so focused on unemployment with an end goal of lowering wage inflation. We know that the time of easy money or cheap borrowing costs is over for now. This is another factor that the Fed is focused on. Home prices had run up considerably, and with sub 3% mortgage rates, it was much easier to purchase a home. 30-year fixed mortgages are now over 7%, and the affordability of home ownership is now much tougher. To date, home prices have come down a touch nationally, but remain relatively resilient so far. That said, there are meaningfully less homes hitting the market, and the time on the market for sale has increased substantially. Considering the Housing Affordability Index on the previous slide, we can understand why many people are looking to rent as opposed to buying a house. Additionally, in the charts on the right, we can see new home building has begun to decline, and that rental properties or multifamily properties are ramping up with new developments. Last quarter, we looked at consumer sentiment hitting the lowest levels in the last 50 years, lower levels than during the financial crisis, when the markets were concerned that the entire financial system was collapsing. This metric takes into account the consumer's opinion on the current health of the economy. This metric too appears to have bottomed, having rebounded back to a 58.6 metric at the end of last month. While we don't know if sentiment will decline further, it is important to consider the subsequent 12-month returns of each of the last sentiment troughs. If you look at the percentage returns located under each of the dates on this chart, you will see the corresponding next 12 months return of the S&P 500. Now, we're not implying that we've hit the bottom in the markets or that the markets are going to take off from here. However, this chart should encourage investors to understand the long-term opportunity that times like these have historically presented. And one of the questions that we hear a lot is, are we currently in a recession? Historically, the generally accepted definition of a recession is 2 consecutive quarters of negative GDP, which we had in each of the past 2 quarters. However, the National Bureau of Economic Research, or NBER, is the organization that officially calls it a recession. And in July, they put forth the following statement: there is no fixed rule about what measures contribute information to the process or how they weighted or decisions. Ultimately, with such a strong labor force and continued corporate earnings, they determined that we are not yet in a recession. That said, they could call for it in the future and backdate the start date. All that being said, GDP for the third quarter is expected to be a positive 2.8%. That, along with OK manufacturing, industrial production, retail sales, job market strength, and continued corporate growth, makes this a difficult call for the NBER. And it's important to recognize that the U.S. is in a very different position than the rest of the world. As we've been discussing for years now, Europe and much of the rest of the developed world has struggled economically. With the war in Ukraine, Europe's situation has been compounded by an energy crisis. It appears as though a continent-wide recession is now inevitable. We continue to find the US to be much better positioned moving forward and continue to minimize exposures in the rest of the world. From a forecasting standpoint, the consensus of analysts believes that earnings will continue to grow. While 2022 is expected to only grow slightly, the look forward does appear to be promising. And ultimately, these earnings are a big part of what companies are valued by. Looking at the chart on the right, we see that earnings have indeed grown at a rate of 5.1% for the year to date, while the markets were down 24.8% at the end of the quarter. Thus, there was an even larger multiple contraction than that of the market performance, which is what can be seen here. Here we consider the 25-year average forward price to earnings ratio of 16.84. As you can see, we have dipped even further below that average to a 15.15. The forward PE ratio considers two factors. One, the price of the stock market. In this case, we're looking at the S&P 500. And the second is the profitability or earnings of the S&P 500. We know prices have come down, but what about earnings levels? Well, they've remained resilient to date. And now we're entering what might be the most important earnings season of this time. This period and next will be critical in seeing how companies have actually performed amid these inflationary pressures. While we're not ready to call for a soft landing scenario, if a soft landing does become apparent, there is the possibility of a very fast and strong rebound. Remember what happened during COVID when the long-term outcome became known. Sentiment jumped and investors stopped caring about the short term and began valuing companies based on the future more than 2 years out. Again, this is not something we are predicting, but it is important to understand the importance of maintaining market exposures. With the decline in stock market prices, we have seen a corresponding decrease in valuation metrics as depicted by the green line here. Additionally, we have seen a further compression in the dispersion of valuations in the markets. In this case, many of the higher valuation multiple stocks have been hit harder. Additionally, this has been a market decline where finding areas to hide has been excessively difficult. In our opinion, this does create greater opportunities for some individual companies. As inflation gets under control and sentiment increases, those companies who continue to execute have the potential of being rewarded at a greater degree. From a style perspective, large cap value has outperformed for the year to date, but growth did perform better than value in this most recent quarter. While it is too early to think that we are through the volatility, there are opportunities within the growth style box, specifically GARP type of companies. Remember, GARP stands for growth at a reasonable price. And we currently find these companies to be relatively attractive. Companies with stronger fundamentals that are able to continue to grow in this environment. Companies with strong cash flows whose valuations are also relatively attractive. To that end, we have moved a touch more towards growth, but do remain close to a neutral style allocation. We remain concerned with the likelihood of continued volatility and have positioned our underlying holdings with this in mind. As mentioned on the previous slide, we are focused on companies that will continue to grow in each of these style boxes. This focus could be considered the more value-oriented subset of the growth style box, or the more growth-oriented subset of the value style box. We feel those are well-positioned companies for the future. Lastly, in each of our equity strategies, we have defensive hedge strategies in place with the intention of dampening that volatility. We will look to these hedge strategies as a source of cash for the future deployment when we determine it appropriate to add some risk back to the portfolio. From a sector standpoint, Our largest overweights are in financials, healthcare, and consumer staples. Our current underweights are in communication services, utilities, and real estate. Right now, energy is being affected by a number of things around the world, and we are maintaining our market weight exposure here. On a relative basis, for the year to date, more value-oriented sectors like consumer staples and utilities have continued to perform. That said, we are beginning to see some shifts in momentum and are closely monitoring these changes. We believe we are currently well positioned from a sector standpoint, but do expect to start making adjustments as indicators begin clarifying where the economy goes from here. Here, we consider our current weights within our core equity model. This quarter, we did make some moves in order to capture some losses for tax purposes where appropriate. We also took advantage of some individual companies' price movements to add some new holdings that looked relatively more attractive from a valuation standpoint. As you can see, we remain relatively defensive from a sector standpoint, and we feel our underlying holdings are well positioned for what comes next. We are continuing to tweak our exposures as we continue to fine-tune this model based on changing market conditions, and we feel we are well positioned to shift more meaningfully as more indicators emerge. The dividend model remained well positioned this past quarter. This strategy has an inherent tilt towards large cap value and the more value-oriented sectors, which has boded well for this model. This model also focused on underlying value companies with growth characteristics, which resulted in stronger performance than the value style box as a whole this past quarter. Additionally, like the core equity model, we also continue to hold a defensive portion within this model to hedge strategies. We are also aware of the implications of inflation and potentially rising interest rates on dividend-paying companies and are thoughtfully positioned with this in mind. Moving into the bond side of things, we have seen the largest intra-year decline in bond prices in the last 50 years. Again, this was driven by the Fed raising interest rates, and we were positioned with the possibility of higher interest rates in mind. This chart represents the entire US bond market, and as you can see, at the quarter end, the US bond market was down 15%. For a couple of years leading up to 2022, we have been discussing our positioning with you and why we believed it was critical to reduce our interest rate risk exposure by owning shorter, lower duration type of bonds. And while all bonds are down in value, the degree to how much is incredibly impactful, and it has given us the opportunity to now buy bonds with a much higher yield going forward. Remember that the length of the life of a bond or duration is directly tied to the impact on the present value of a bond for a given change in interest rates. The present value of a bond is just a time value money equation of future interest and principal payments discounted by today's interest rates. Here, we consider the change in value of a bond based on a 1% increase or decrease in interest rates. For example, a bond with a 2-year duration would be down about 2% for a 1% increase in interest rates, while a bond with a 10-year duration would be down about 10% for that same 1% increase in interest rates. Make that a 2% increase in interest rates, and the 10-year duration would be down about 20%. I hope this paints a picture. The takeaway here is that we had maintained a shorter duration in each of our bond strategies, and now that rates are higher, we're moving the duration out incrementally to lock in these now higher rates. This is a big win for our clients, as we were able to mitigate a good amount of the interest rate risk as rates rose and are now moving out durations marginally with higher interest rates going forward. This past quarter, we have continued to witness yields moving further upwards, which will further benefit our clients in the long run. Previously, as seen in the gray line, there was minimal upside in yield for extending our portfolio duration, and there was too much corresponding interest rate risk associated with such a move. Now that this risk return profile has shifted and our clients have been rewarded with less downside exposure, We are shifting some of our portfolio durations to reposition for this new interest rate environment. We are still not being overly aggressive here, as rates can move higher, but it does appear as though the currently scheduled interest rate hikes are already priced into the yield curve. This chart shows us where the Fed funds rate is today and where it is projected to go. The gray square at 3.13% is where we are today. As you can see, the markets are expecting one more rate hike to a 4.21% and then maintaining near that level going forward. The Fed's latest estimates project slightly higher levels, but really quite similar levels. If the markets and the Fed are correct, this is supportive of our current positioning and implies that we will be reaching the targeted levels with the next expected rate hike with a possible small follow-on hike. Looking at the entire yield curve, much of this appears to be priced into the market. Lastly, the Federal Reserve has begun selling its bond holdings into the market. Remember, during and post-COVID, the Federal Reserve purchased near $5 trillion in fixed income securities to normalize the bond market's interest rates. It is now selling these bonds into the markets, which is increasing the supply side of things. This adds some additional pressure, which will make it harder for interest rates to fall. However, with the myriad of items that we've discussed today, we believe that interest rates should normalize around these levels for the next couple years, and we are positioning with this in mind. I should note that we are finding bonds right now that we find quite attractive and believe this window offers us a long-term opportunity within the fixed income markets. So in conclusion, given all available indicators and economic data, we continue to feel well positioned in each of our strategies. While it is likely we will continue to witness some volatility as we move forward, we feel strongly about the companies that we currently own and the way we are positioned going into the remainder of the year. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, and we look forward to speaking with you soon.